Are you a real estate investor looking for a loan that doesn't rely on your personal income? In today's video, we'll dive into DSCR Loans, a powerful financing tool that lets your property do all the talking. Whether you're expanding your rental portfolio, purchasing your next investment property, or refinancing for a better cash flow, a DSCR loan could be the game changer that you need. We'll cover how these loans work, the key benefits, and the potential pitfalls every investor should know. Stay tuned and learn how you can leverage DSCR loans to grow your real estate empire. Full disclaimer. This video contains real estate funding secrets that gurus charge unsuspecting new investors thousands for. But I don't care, guys. You know why? Because I'm just here to share helpful information so that we can all be self-paid in the shade. And to be honest, I don't know if you guys are ready for this one. I really don't know, because I'm about to go in. So buckle up, get your notepads ready, and pay attention. By the end of this video, you'll know how to purchase investment properties with equity. By the end of this video, you'll know how to purchase an investment property with an LLC. And by the end of this video, you'll even know how to buy an investment property with no money.
How, Sway?
Keep watching and you'll know what I mean. What's up, guys? My name is Kelvin McNeil, and I'm a licensed mortgage loan officer, NMLS number 201-8085, and welcome back to my channel where we discuss credit restoration, business funding, and real estate. As a mortgage broker specializing in investor financing, I'll focus on securing loan products that align with real estate investors' goals. Whether they're acquiring real estate properties, commercial buildings, or conducting six-figure fix and flips, my job is to help investors navigate complex financial products such as DSCR loans, portfolio loans, and other non-QM loans, and match them with the right lenders. Every day I have the pleasure of talking to new and experienced home buyers to secure their first or their next investment property through little-known loan programs like the one that we'll be covering today. Did you know that 90% of millionaires have built their wealth through real estate? You see, this highlights how investing in real estate has always been a key avenue for creating and preserving wealth across generations. And lately, my clients have really enjoyed the convenience of closing deals with DSCR loans. But before we do a deep dive, let's start with the basics. What is a DSCR loan? Well, a DSCR loan stands for Debt Service Coverage Ratio. In short, it measures a property's ability to generate enough income to cover its debt. Can your estimated mortgage be covered by the rent? And I'll show you how to calculate the ratio later on. So again, you're gonna want to stick around and watch this whole video. But what are the pros and cons of a DSCR loan? First off, DSCR loans are some of the easiest loans to originate because the most common issues that we typically run into as loan officers stem from income. Whether it be from low income, unverifiable income, or time in employment, because with standard qualified mortgages require 2 years minimum employment history. But that's not the case with DSCR loans, because not only is personal income not required, we're literally not allowed to include any personal income on the application. And this is huge for self-employed borrowers, because that means it doesn't matter if you haven't even filed your taxes yet, or if you've written too much off, like some of you guys do, of your income, as we will not be asking for any of your tax returns. So without the need to verify personal income, this makes DSCR loans faster and easier overall to qualify for. Additionally, these loans close typically in around 2 weeks, which allows you to make strong offers with these motivated sellers. Another positive is that you can actually close in your LLC, treating the subject property like a true business. And sometimes DSCR loans won't even show up on your personal credit report, although it often does for first-time investors. Now, with DSCR loans being investor focused, a lot of different property types qualify, like single-family homes, multifamily homes, multi-use properties, and some commercial real estate. Not to mention, you're still able to secure a 30-year mortgage, which can help cash flow by keeping your monthly payments low. And lastly, some DSCR loans allow you to refinance at any time without any seasoning compared to conventional loans where they force you to wait 12 months. Now, of course, this does vary based on the strength of your deal. These are just a few of the advantages of a DSCR loan. Now, you know I'll always keep it real with y'all, right? It's important to weigh the benefits as well as some of the drawbacks based on your specific investment strategy. So now let's talk about some of the disadvantages of a DSCR loan. Like any financing for investment properties, you're typically going to have a higher interest rate compared to conventional loans due to the higher risk for the lender. I mean, think about it. They're qualifying you solely based on the property's cash earning potential.
Oh, that makes sense.
While completely ignoring your personal income. And for the same reason, you're going to need to meet them halfway by making a larger payment. And this one isn't the biggest deal, but most of the time they do come with a prepayment penalty that ranges from 1 to 5 years. And lastly, they are limited to income producing properties. So the following property types are ineligible. The first would be, for example, properties that are located in a rural area because they tend to make terrible rental markets. Also, no owner-occupied single-family homes because it needs to be rented out. And some lenders don't allow Airbnbs, but you just have to work with the right one that knows how to properly calculate short-term rental income using tools like AirDNA. So it's all about working with a knowledgeable broker like myself, and I've got you. All right, so real quick, I got to call a 30-second timeout. Now that you know the pros and cons of a DSCR loan, I want you to pause this video if needed and drop a comment right now telling me what you think about the pros and the cons. More specifically, do you think the pros outweigh the cons and why? Next, let's talk about who qualifies for a DSCR loan. Well, both individuals and business entities, which means you get to choose if you want to close in your name or your business's name. And believe it or not, yes, first-time home buyers and even first-time investors can still qualify for a DSCR loan. And lastly, both U.S. citizens and foreign nationals can qualify. Now, here's the most important part of this entire video, so you may want to pay attention. What are the minimum qualifications of a DSCR loan? It really comes down to about 3 components. A, your ratio. B, your credit score. And C, your cash to close. Now, allow me to break this down for you, starting with the ratio. The debt service coverage ratio is calculated by simply dividing the net operating income by the total debt service, aka your monthly mortgage payment, including taxes and insurance, otherwise known as your PITI payment. Remember, on average, we really need a ratio of about 1-to-1, where our rent covers our mortgage. Let me go ahead and show you how to calculate the DSCR ratio. If you want to follow along, you can join me by visiting my website, which is applywithkelvin.com. And here you will find some calculators. So you just hit the menu, go over to calculator, and then you'll see all of the calculators that I have on my website that are related to, of course, real estate. So let's go ahead and go over to the DSCR calculator. And I will admit, it is a bit advanced, so we're going to ignore cash flow and cap rate. Let me go ahead and wipe this all out. We're going to start off fresh. In this scenario, we're going to do a purchase. And for the sake of keeping it as simple as possible, let's just say there's just one unit, so a single family property. Let's say the purchase price is about $300,000. Let's say you are earning about $2,500 a month in rent. And then, all right, the next question is annual property taxes, because you will need to figure out what the property tax payment is and the annual insurance. So if you're curious and there's a specific property or a zip code you want to find out, you can come over to smartasset.com, come to the property tax calculator. Let's say I want to find out what the property taxes would be in Durham, North Carolina, 27703. I go ahead and put in the property value, 300,000, and bam, it tells me right there. I can just go ahead and plug and play this number right here. We got 3090. We're going to put 3090. Now, annual insurance typically is going to be around $200 a month. That's going to give me $2,400. Now, of course, the insurance is something that you can shop for. So you can always go and get a cheaper rate. But for the sake of this video, that's what we're doing. All right, now let's just say also that there is no HOA fee. This gives us all the information we need. And then you come down and it says, boom, the DSCR rate is 1.13. So how do we come up with this 1.13 number? Well, if you break out your calculator, all you'll have to do is, again, look at whatever your estimated monthly rent is. So in this case, $2,500, and divide that by your estimated monthly payment, which includes your taxes and insurance. So that will come up to, and I'm doing it right now on my calculator. On my calculator, it shows 1.126. You round that up and you got 1.13. So that would tell us that this is a good deal because the DSCR ratio is above, it's more than 1-to-1. It's actually 1.13. Now, the second component is, of course, your credit score. Generally speaking, most DSCR loans require at least a 660 FICO score, but it varies by property type. And this goes hand in hand with the third component, which is cash to close. And down payments on DSCRs range from 35 to 20%. You see, the lower your credit scores, of course, the more you have to bring to the table. For example, if your FICO scores are between 620 and 679, the average lender may only finance 65 to 70% of the loan to value, which means you may have to pay 30 to 35% down. However, if your scores are between 680 to 699, the average LTV is around 75%, which is 25% down. And lastly, if your scores are above 700, you may only be required to put down 20%, which is ideal. As you see, having good credit can be the difference of up to 15% of the purchase price, which you could have kept in your pocket. Now, this is why I tell you guys all the time on my channel, business credit is cool and all, but you cannot neglect your personal credit. And if you need help improving your credit scores, my team at Greenscale Credit has your back. So feel free to schedule a free credit consultation at our website, which is greenscalecredit.com, or by clicking the link down in the description of this video. Well, of course, the first thing you'll need is an application. But besides that, we'll need proof of ID. And if you're closing in your LLC, we'll also need standard business docs like your articles of organization to validate your business and your operating agreement. Now, listen up. The operating agreement is where some underwriters may get a little picky. So my pro tip for you is to make sure that your operating agreement specifically mentions property management or real estate investing. Otherwise, it could possibly delay the closing. And the next document we'll need is bank statements to prove you actually have the down payment in your possession. And you know what? I just remembered this one. This one is a mega pro tip. And I promise, guys, it's not off topic. So one of the most popular ways my investors fund the down payment is by getting a home equity line of credit. So if you own another property, right, with enough equity to cover the average down payment, which is 25% plus closing costs, it would allow you to purchase an investment property with no money out of pocket.
I love it.
Now, the key thing here is making sure to go ahead and transfer the funds from your HELOC into your checking account for proof of funds. And honestly, I should have included this next part in the pros and cons list because this is definitely one of the advantages of DSCR loans, which is your closing costs and all of your cash to close can be 100% funded by a gift, which would never fly with FHA.
You've truly got a gift.
So, all right, y'all. I told you everything you need to know about DSCR loans. And if you would like to request a quote from yours truly, then of course you can head over to my website at applywithkelvin.com. That's Kelvin with an L, where you can schedule a mortgage consultation so that we can discuss your loan scenario or the property that you're looking to purchase. Our brokerage is licensed in 48 states, and the only states that we don't do any business in is Massachusetts and New York. I know. Sorry, guys. And additionally, I'll go ahead and drop a link for a HELOC, a home equity line of credit, in the description below if you want to leverage some of that equity. But of course, I can also help you with the cash out refinance with the rates dropping as we speak, if that's your preference. But either way, we'd love to help you fund your next deal. So tell me, now that you've got the scoop, what do you think about DSCR loans? Also, there's no such thing as a dumb question. All right, let it all out. But if you found this video helpful in any way, make sure you share this video with someone who could also use this information, and like this video to let the algorithm know that I did a good job, and subscribe for more. I hope you guys enjoy the rest of your morning, afternoon, or evening, whatever time of the day it is, and I'll catch you guys on the next video.